Hello everyone, you're welcome to my channel Promotion for Short. In this video, we are going to talk about analysis of financial statement, Module D of Credit Management Advanced Bank Management course of CAIIB. Now in this chapter, you will learn about the types of financial statements. What is fund flow, cash flow statement? The importance and uses of financial statements in credit appraisal, projected financial statements, analysis of financial statements, relationship between items in balance sheet and profit and loss account, trend analysis, ratio analysis. Now, whenever a bank considers a loan proposal, apart from the integrity and KYC, it is interested to know the financial details of the borrower. Now, why is the financial details of the borrower required? The financial details of the borrower will give the net worth of the applicant, which is his excess of assets over his liabilities. Now, the net worth of an applicant helps the bank in deciding the level of activity which may be desirable by the applicant and the amount of money which can be lent to him. That is why the bank look for the financial details, the financial statements to get the net worth of the applicant. Also, the bank will analyze the repayment capacity, the viability, the availability of unencumbered securities which can be held as a collateral while giving the loan. But what is a financial statement? Now, financial statements are basically two financial statements which every business enterprise is required to prepare. These are balance sheet and profit and loss account, which is also income and expenditure statement in case of non-profit organization. Now, apart from these, the auditors report, explanatory schedules, and notes on accounts also provide very useful information to the bankers. Accounting Standard 3 makes it mandatory for some enterprises to prepare cash flow statement for the accounting period. These enterprises are also required to do segment-wise reporting as per Accounting Standard 17, AS 17. Now, what are the uses of financial statements? Now, apart from bankers, the other users of financial statements are creditors and lenders, investors, government agencies, rating agencies, customers, employees, general public, analysts, etc. Now, what are the important basic concepts which are used in preparation of financial statement? Entity concept, money measurement concept, stable money unity concept, going concern concept, cost concept, conservatism concept, dual aspect concept, accounting period concept, accrual concept, realization concept, matching concept. Now, legal position regarding financial statements. The Companies Act 2013 has prepared the formats for both balance sheet and profit and loss accounts, which the financial institutions are obliged to follow. So if you talk about balance sheet, what exactly is a balance sheet? Now it is a statement of asset. Asset is something which is owned, in liabilities which is owed to others of an entity at a particular date. So whenever you see a balance sheet, it is as on a particular date. So one day after, the balance sheet may change. In fact, every 1 hour it may change. What is profit and loss account? Now it is a statement of income and expenditure of an entity for the accounting period. Every profit and loss account must indicate the accounting period for which it is prepared. Now these are certain things which definitely the banks do take care into consideration. What is fund flow or cash flow statement? Now each item in the balance sheet represent either source of fund or use of fund. All items on the liability side represent the fund provided to the enterprise, And all items on the asset side except cash represent use of these funds. Now, cash in balance sheet represents the unutilized portion of funds available to the enterprise. Now, what do you mean by projected financial statement? Now, in case of a new enterprise where no financial statements are available, it becomes necessary to decide on a level of activity and accordingly prepare a projected financial statement. Now, in case of term loan for new projects expansion, projected financial statements are normally prepared for the entire duration of the bank loan to establish viability of the operations and to determine the disbursal and repayment schedule. Now, what is purpose of analysis of financial statements for the bankers? What do the bankers get from financial statements? They get the assessment of performance and financial position. They get projection for future performance. They can detect danger signals for assessment of credit requirements, examine funds flow, cross checking. So, if you have to rearrange the financial statement for the purpose of analysis, you can rearrange in a very simple way. Now, liabilities, if you see, the most important things which you need to see from the liability side is tangible net worth, which is shareholders' fund, long term liabilities, and current liabilities and provisions. Now, if you have to look at the asset side for analysis, for the purpose of analysis, you will see fixed assets, current assets, and non current assets. Now, this is something which you should always keep in mind while you are rearranging the financial statement for the purpose of analysis. Installment of term loan due within 1 year, you need to consider this. Advance tax or provision of taxes, if any. Deferred tax assets and liabilities, non moving inventory, receivables more than 6 months old, revaluation of assets and intangible assets, investments, bill purchased and discounted, contingent liabilities, provisioning, depreciation, inventory, expenses relating to earlier years, and important events after account period. Now, what are some of the techniques used in for the analysis of financial statements? Normally, there are three techniques which is used for analysis of financial statement. First is fund flow analysis. Second is trend analysis, and the third is ratio analysis. Now, these three type of different analysis helps the banks to get a good idea about the individual, the borrower. So there are various aspects which the fund flow analysis will observe, the trend analysis will observe, and the ratio analysis, which considers profitability ratio, liquidity ratio, capital structure ratios, ratios in indicating ability to service interest and installment, turnover ratios, inventory turnover, debtors turnover, etc. Now, these are the important ratios which needs to be considered before a bank thinks of giving a loan to an individual. So I hope this video would have given you a lot of insight and valuable information on this topic. So if you like this video, you can press the like button, subscribe to my channel and share it on social media. Help us to spread education in this beautiful world. Thank you. Have a great day. Bye bye.